Okay, guys. Um, Hello, everyone, and welcome in. Would- Well, I guess I would first start with sending my apologies for not coming live on time. But tonight we're gonna continue with our live stream or live webinar, which we titled "The Naked Chart 2.0." And as you know, this is the continuation of our previous webinar, which we haven't finished on time. And now we're going to try our best to finish everything today in this single webinar. So here's what we're going to be covering tonight, and also why we are going to be dropping, why we're going to be continuing from where we dropped in the last live stream, and also what we will cover throughout the session. So we're going to talk about how to read structure and labels, how to spot real breakouts versus traps and fake outs, and also we're going to talk about the candlestick patterns or the candlestick chart patterns which are worth knowing. And then we will also talk about the two powerful chart patterns called double top and double bottom. And then we'll be bringing it all together into one simple checklist, which you can use in your trading journey, or which you can be using whenever you enter the market and when you are trying to trade. And so by the end of this hour today, you will be able to look at any chart anywhere and actually understand the story it is telling you. And you can be able to look at the chart clearly and understand everything. So let's get right into it. Yeah. So we will start with one of the biggest questions. Um, let's proceed to the so well I'm gonna be in the charts, in the chat section, just in case anyone might have any question today. But we will try to move as fast as possible so that we can finish everything today uh, on time, of course. Well, All right, guys. I hope you can all see the screen. And so, just like we explained on our last live stream, I wanted to give you a quick overview or a quick review of what we have done on the last live stream, just in case you are joining us today and you haven't actually joined the last webinar, or even if you joined the last webinar, but I'm just going to give you a quick overview of what we have done before and what we're going to be doing today. And so, first of all, if you look at the left side of this image, you can see that most traders look at their screen or their chart looks exactly like that. They have many different indicators, many different tools, maybe 5 or 6 different tools, all stacked on top of each other, and they are all fighting for a space within their screen or within their chart. But the honest truth here is that when many people have a screen like that, it is too confusing because you have many different information, you have many different things telling you the same thing at the same time, which is sometimes a little bit confusing, especially if you are not a professional trader or if you are not an expert trader. You might find it very difficult to understand what is actually going on in your screen or in your chart. But when you look at this clearly, from the right side, you can see that the chart is very clear and it is very clean. You can see that everything is clean. Anybody can look at the screen, anybody can look at their chart. If your chart is that clean, you can be able to understand your chart and you can be able to read your chart throughout. So this is just a review of why price action matters today. And so what we're going to be doing is that we will help you get rid of all those technical indicators or all those tools and focus on just the chart itself, the price action itself. And by looking at your screen, you can be able to understand what is happening and you can be able to understand what the chart is actually telling you. And so we're gonna start by talking about market structure. And let me open this screen. That awesome. Yeah, so this is a market structure, and when you look at the but first of all, the market structure is actually telling you what is happening, or it is giving you the story of what is happening within the chart. When you see an uptrend, which is a sequence of higher highs and higher lows, and sometimes when price pushes up to a new peak or it pulls back, but then that pullback holds above the previous low and then it pushes an even higher peak. So as long as that keeps happening, you are in an uptrend or in an upward trend. And then a downtrend is the exact mirror of that, which is lower highs and lower lows. And every bounce falls below that last peak, and every low undercut the previous low, which means it continued to go in a downward direction. And that is a lower low. But here's the part I really wanted you to remember. The moment that pattern breaks, let's say you are in an uptrend and suddenly you get a lower low, that's your first clue that something is actually going on, or the market is actually shifting. You don't need an indicator to see that, and you don't need an indicator to tell you that. The structure itself tells you what is actually happening, what is actually going on. And one more thing, sometimes the market isn't even trending at all. It is just moving sideways between the ceiling and the floor. If you join our last webinar or our last live stream, you will understand what we mean by the ceiling and by the flow. But still, I'm going to explain this if you haven't joined our last webinar. But when that happens, don't force a trade. Most traders loses money at that point because they were trying to open a trade when the market itself is fighting between sideways. So don't trade or don't open any trade at that moment. So once you know the direction the market is moving, the next question is where exactly should you expect the market to react, or where exactly should we expect it to react? That brings us to support and resistance level, which I just talked about a couple of seconds ago about the ceiling and the floor. And so, as I said, guys, we are just doing a quick review of what we have done last week, but then we will continue from where we stopped. And so just a quick overview on support and resistance level. I'm gonna open the screen so that you guys can see the screen right here. So focus on your screen, you can see the support and resistance screen. Yeah, so you can look at your screen now and you can see that first of all, support is a price zone where buyers keep stepping in and stopping price from falling further down. Think of it like a flow. And resistance is the opposite. And so think of the resistance as the ceiling. The flow is the support level and the ceiling is the resistance level. A ceiling is where sellers keep showing up trying to stop the market from advancing and capping any advance of the market. Why does this actually happen? So this is not a magic. It is actually a memory of the market. Enough traders remember what happened last time when the price got to that level, that exact level, and then they place their orders at that exact location or at that exact level, and that is why it forms a support level. It's just that the last traders or the traders look at the market and remember where price stuck before. That collective memory turns into a real buying or selling pressure. It is the same case for the sellers side. So that's what happened. So when you see the support level, it means that the buyers come in, and when you see the resistance level, it means that is where the sellers actually come in. And when a resistance level finally breaks, it doesn't just disappear. Very often it flips and becomes support on the way back down to receipt or to sort of retest that level. And that is one of the most repeatable patterns in all of trading. So you have to keep your eye out, you have to keep your eye open throughout your trading session. So now that we understand quickly what support level and resistance level means, let's talk about what happens when price actually pushes through one of those levels, either the support level or the flow, or the resistance level, that is the ceiling. So let's talk about the breakout and the fake out. But let me put this thing in your screen so that you can also see that. So if you look at your screen right now, real quick, a breakout is when price closes decisively beyond a support or resistance level with real strength behind that move. So if you look at the left side here, the left side in your screen, you can. I want you to focus on your screen. Look at the left side. You can see that the candle actually closes beyond that level. So there's a real momentum behind it, and when price come back to retest that level, it holds rather than falling back through. And a fake out almost look identical at first, but what happened is that price will pulse beyond that level. Everyone will get excited and think that a breakout is about to happen, but it is not actually going to happen. And so when you look at the right side of the screen, you can see that there's no strong close, no follow through, and it snaps right back inside, trapping everyone who chased it or anybody who opened a position at that point. And so a fake out is a breakout that is not actually a breakout. It is not as strong as the breakout looks. And so it just traps buyers. When you saw a fake out and you quickly open a position, you get into that trap and you are more likely to lose money on that particular trade. So here's the three question filter I want you to remember. Before you ever trust any breakout, you have to ask yourself, did it close beyond that level? Not just a wick through it. If it is just a wick that pierced through that level, do not trust it. It is a fake out. It is not a real breakout. But if you can't say yes to all those three questions, don't chase it. Don't open any trade. Wait for the retest to prove itself whether it is a real breakout or it is a fake out. And so that is practically what a breakout and fake out is. A breakout is when the position or the market or the price pushes above either a support level or a resistance level. So a fake out is when it just peers a little bit and right quickly snap back into that level and trap everyone who chased that level and people end up losing their money. And so now that we have covered structure, levels, and breakouts, which is the whole foundation of this webinar, we're going to zoom out into a single candle, because every one of those candles is actually telling you a story too. It is not just a buying and sell, it is actually telling you something. And if you want to understand that, you have to stay focused. But also, let me put the what do we call this, the let me put the code so that people can actually use the promo code. So guys, here's the promo code. Yeah, I hope everyone can see the promo code right here. So here's the risk-free promo code. But guys, you have to stay focused. Yeah, that's great. So guys, you have to stay focused and don't leave the screen, don't leave your screen, don't leave the webinar and chase the risk-free code. You can use the code while you are listening to the webinar, or you can focus on the webinar, and after that you can use the promo code. But anyway, here's the promo code, and let's continue with candlesticks. So let me push it right this side so that it doesn't close our distance. Okay guys, I hope everyone can see the yeah, so here we are. But before we get into any specific patterns, let's make sure that everyone here understand what a single candle is actually showing you. It doesn't matter if you know, that's great. We will move as quick as possible because we are just making a quick review. And if you don't, you have to focus and listen, open your ears and your eyes so that you can understand what I'm trying to explain. And if you haven't joined our last webinar, this will be very simple for you. And if you did join, it will still be pretty much simple to you. And so before we get into any specific patterns, let's make sure that you understand that. Because every pattern you see, or every pattern we're going to learn tonight, is built from this one shape, the candlestick. Every candle you see has a body at its middle, or in its middle, and that is the distance between where price open and where price actually close. Above and below that body, you'll often see thin lines, as you can see in your screen now. In this candlestick, you can see some thin lines above and below, or sometimes above or sometimes below. Those thin lines are called wicks. They are called wicks, or sometimes they are called shadows, but they are mostly called wicks. The upper wick shows you the highest price that the price reached, and the lower wick shows you the lowest price, or the lowest point the price actually reached. So when a candle closes higher than it opened, we color it green, or the color is green, and we call that a bullish candle. And a bullish candle is actually telling you that the buyers have won that round. And so if it is a fight between the buyers and sellers, every candle tell you who win that fight. And so if buyers won that fight, you will see a green candle. And when it closes lower than it opened, we call it red. And a red candle is called a bearish candle, which means sellers have won that round, or sellers have won that fight. And so that is generally what candlesticks actually telling you, or what it really means. And so every single pattern in the next few minutes that I'm just going to be explaining, it is just a different combination and shapes of this one simple building block, the candlestick, a body and two wicks, and then a color which is actually telling you who actually wins. So it doesn't matter, either the color is red or the color is green. Green color, bullish candle for buyers. Red color, bearish candle for sellers. And so now that we can see those parts, and now that you have understand what candlestick means, let's group them into the patterns, or chart patterns that actually matter. Starting with one that tend to show you, or that tend to show up when buyers are actually taking control of the market. And so let's get straight into the patterns. Okay, so I want you guys to look at your screen. You can see we have actually 1, 2, 3, 4, 5. We have 5 different candlesticks, and so starting with the first one, which is called the hammer. So I want you guys to actually look at your screen and also listen very carefully. A hammer is a small body sitting near the top of the candle with a long tail stretching down below it. Just like a normal hammer, just like a normal hammer, it looks exactly like the normal hammer, just like you can see it right now in your screen. Um, yeah, here's the I don't know if you are not seeing the promo code clearly, but let me make it a little bit bigger or bolder so that you can see it actually clearly. Okay, so guys, but guys, please focus on the live stream, not just the promo code. You can use the promo code, but you have to focus your attention on the live stream. Okay, so as I was saying about the hammer, just like you can see it in your screen, but one thing I want you to focus on, you don't have to care about the names. Okay, if you understand what they means, the name will automatically come back to your head. So just listen attentively and very carefully so that you can understand. So what that means, that long tail, that long tail beneath the hammer, or that long wick, is a proof that sellers pushes price down very hard or really hard, but buyers fought back fiercely and drag it almost all the way back up to the top before the candle closed. So that is actually what happened. Sellers comes into the market, push the price down, and buyers comes in and fought back fiercely until they push the price up, and then the candle closes as a green candle. So it tells us that the selling pressure might be running out, and now that the buying pressure might be much more effective, and the buyers are much more capable of taking the total control of the market. But what you have to do is you have to wait for the next candle. You have to wait for the very next candle to confirm before acting. So when you saw a hammer, or when you see a hammer while you are trading, don't just open a long position or don't just buy. You have to wait for the next candle to confirm you whether buyers are actually going to take the control of the market or if it's not going to happen, because these chart patterns can tell you what is actually going to happen, but nothing is 100% guaranteed. So you have to wait for confirmations and you have to be patient. Okay, and so that is for the hammer. It means much more when it forms as I was just adding on top of that, if when you are looking at a support level and you saw a hammer, that is the best time you can open a position, because you will have a stronger conviction that the market is going to go up, because you have a strong support level, and now you have a hammer, which means that the market will go up. And so then the next thing we're going to talk about is the bullish engulfing. And so we have talked about this in the last webinar, but if you haven't joined the last webinar, we will talk about it today again, but really quick, so we're going to move faster. So a bullish engulfing is a small red candle followed immediately by a very much bigger green candle that completely covers it. It completely swallowed the last red candle, which means sellers won a battle in the first candle, the red candle. Then buyers come in so strong that they erase the entire move and even create a much bigger candle. And that is a bullish engulfing. It is a real visible shift of power from the hands of the sellers to the hands of the buyers. Especially, it is very powerful when it happens around a support level or at a support level. Okay, so when you saw a bullish engulfing happening around a support level, it is telling you that this market is actually going up. And that is a very good time for you to open a long position or to buy or to open a buy order. Okay, and so the next pattern is a morning star. Just like you can see it in your screen. This one take 3 candles, as you can see. It has a very long red candle showing that sellers are in control of the market, and then a small hesitant candle. That small hesitant candle means that nobody knew what's going to happen. So nobody is sure whether buyers are stronger or the sellers are stronger, or whether buyers are going to take control or sellers are going to take control of the market. And so after that hesitant candle, the next you will have a strong green candle that pushes back deep into that first red candle's body. That full journey, strong selling, a pause, then strong buying, it is what gives the pattern a real weight. And so that is when you have a morning star, and a morning star is actually telling you that the market is bullish or the market is going to be bullish. But always you have to wait for all the 3 candles before trusting it. You have to wait for the first red candle. When you saw the first red candle, you have to wait for the second hesitant candle, that small candle, and then you have to wait. Don't just execute a trade after you saw that small hesitant candle. The market might continue to go down. So you have to wait for the next green candle to form, and also not just wait for the candle, but wait for the candle to close. Until the candle closes completely, that is when you have a morning star. And then you can open your position. And especially if you have it open around a support level, maybe you have a higher high or around a higher low. Depending on the level, you can see the levels, and so you can execute your trade. But you have to be patient in waiting for those patterns to completely form before you open any trade. And so that is the morning star. And then the next is the inverted hammer. Okay, so just like you can see the inverted hammer, uh, it is a small body near the bottom with a long tail pointing upward, appearing after a decline. So buyers tried pushing higher during this candle and got some pushbacks, but the fact that they even tried after a drop is an early hint that they are waking up. It means that buyers are now waking up, and there's a chance, or the market is more likely to go in an upward direction. But whatever the case, it is just telling you that since the buyers are now waking up, there's a pretty good chance that the buyers are going to come in and take control of the market. And so you have to be optimistic. But this one is a little bit weaker than a hammer on its own. But you have to wait for a strong green candle to follow it before you trust the inverted hammer. So it is not like the normal hammer. Okay, it is much weaker than the inverted hammer. So when you saw that happening, you have to wait. Patience is very important, and patience is key to success in trading. So you have to wait for a strong green candle to follow it before trusting it. So that is the inverted hammer. And then the last in the list is the piercing pattern. So you can see it is very simple. It is a red candle followed by a green candle that opens even lower, but then pushes back up and closes more than halfway into that red candle's body. So it is a slightly gentler cousin of the bullish engulfing, as you can see. But what that means is that buyers didn't fully recover, or buyers didn't fully cover the previous candle, but they then clawed back a serious amount of ground, or maybe a serious amount of liquidity, which still tells you that a real buying pressure is slipping in, and there's a much more chance that buyers are more likely to take control of that market. So now let's flip this around completely and look at these patterns are bullish patterns. And so we're gonna flip around and look at the 5 patterns that show up when sellers are the ones that are actually taking control of the market. So we're gonna move forward with the next patterns in the list, but the bearish patterns. So these are the bullish patterns. I hope you guys are understanding what we are doing. Okay, that's great. So now these are the bearish candlestick patterns. So guys, you have to look at your screen very clearly so that you can understand what we're talking about. Okay, these are five simply these are the mirror of what we just covered, showing up the sellers are now taking control of the market, usually after a bullish rally. Okay, so the first we're gonna start with is a shooting star. A shooting star is a small body near the bottom with a long tail or a long wick pointing upward. So it is appearing after a rise. And what happened is that just like before in the bullish momentum, here buyers tried pushing the price to a new high during this candle, but then sellers slam the door and come in fiercely and drag the market back down before the close. And so that is actually what happened. But you have to wait for the red candle to confirm, ideally near a resistance level, before you open any trade or before you open any uh, um, short position or sell position or sell order. So that is a shooting star. Just like you can see it, it looks exactly like this, and it is the same story as before. The bearish engulfing, just like we have the bullish engulfing in the bullish market for the buyers, we have a bearish engulfing as well. And the bearish engulfing is a small green candle followed immediately by a much bigger red candle. And that red candle completely covers the green candle. And what happened is that buyers want a little bit from the beginning, which is the green candle, and then sellers come in with a much bigger resistance, or which uh, fought back fiercely and erased the entire gain in one move. Just like it happened in the bullish engulfing. In the bearish engulfing, the story is the opposite. This one is for the sellers. Buyers try to come to take over the market, but then sellers comes in and push the buyers strongly with a much more stronger resistance, and then they completely overwhelm the buyers and take control of the market. And so bearish engulfing is just showing you the real shift of power from the hands of the buyers to the hands of the sellers. And especially the bearish engulfing, when it happened, especially in uh, near a resistance level, that is a good chance or a good signal that the market is actually going to reverse and continue to go in a downward direction. And so it is a good time for you to open a short position or a sell order, whatever. And so the next in line is evening star. Okay, just like we have the morning star, now we have the evening star. And the evening star is actually the mirror of the morning star, as you can see. It is a long green candle, the opposite of the morning star. It is a long green candle, then a small hesitant candle, just like the morning star, and then a strong red candle pushing back deep into that first green candle's body. But just like before, you have to wait for all the three candles to complete before trusting it. Before trusting the evening star, just like the morning star, you have to wait. You have to be patient until everything happens completely. And also, you have to pay attention to whether it is forming near a resistance level or not. When it is forming near a resistance level, that is a very strong signal that the market is actually going down or is actually going to go in a downward direction. So that is the evening star. Okay, uh, that is great. Yeah, that's great. So I'm glad everyone is actually with me. So the next in line is the hanging man. Okay, and so just like we can see the hanging man, it looks exactly like a hammer. It has a small body just like the hammer and a long tail below it, or a long wick below it. But it shows up after a rise instead of a fall. So this is the opposite of a hammer. Okay, it shows after a rise instead of a fall. And that context flips the meaning completely into a warning that buyers might be losing their grip on this trade rather than a buying signal. And so treat the hanging man as a cautious flag, not an entry level for you, not an entry signal for you, until a bearish candle confirms it. When you saw a hanging man in your chart, don't rush to open a sell position or a sell order. Be patient and wait until you have another bearish candle or another red candle confirming that the market is actually going down. So this is very important. Okay. And the next one, we have the dark cloud cover. Sorry, guys. So just like we can see, as I have already told you, it is just the mirror of the bullish patterns. So the dark cloud cover is a green candle followed by a red candle, the opposite of what we talked about before. And so it is a green candle followed by a red candle that opens even higher, but then pushes down and closes more than halfway into that green candle's body. And so it is a gentler cousin of the bearish engulfing, uh, just like we talked before. What happened is that sellers didn't fully cover the previous candle, but they took back serious ground and come back fiercely and take their positions, which actually tells you that there's a real selling pressure coming, or a real selling pressure has actually arrived, and that sellers are now actually going to take control of the market. So that's what actually happened. And so now that every candle picks a clear side, the bearish side and the bullish side, let's actually look at the patterns that simply mean the market hasn't decided anything yet. So we call this the neutral candles, because they are not actually telling us either the market is going up or either the market is going down. So here are the neutral candles. Some of them you knew them if you joined the last webinar or the last live stream, and whether you know them or not, we're gonna talk about them now. So this last four candlestick that you are looking at, these patterns aren't about buyers or sellers winning. Okay, they are about nobody actually winning, and that is what they are telling you. They are just a useful because they tell you when to be patient instead of when to act. So there's a difference between the last candles that we just covered and these candles. Those candles we covered before are actually telling us whether to buy or to sell, but these ones are going to be telling us not to do absolutely anything, but to be patient and to know when to actually act or when to buy. But I want to do something before we move forward. We're gonna open the chart because we have been talking about theories all this long. We're gonna open the chart, look at some examples, and then we're gonna come back to these neutral patterns, and then we will finish the patterns, and then we're gonna talk about double top and double bottom, and then we can close the live stream. Okay, so let's go into the chart now. Here we are. Okay, okay, so we are now back into the chart. And so guys, I want you to actually focus on what is happening here. I'm going to remove all this quickly. Okay guys, so before we actually talk about how the chart look messy, look chaotic, and with many different indicators and all of that, but here there are no much indicators, just RSI and some moving averages. But this is how the chart looks like. Now we're gonna clean the chart and clear it so that the market is gonna look very clean. So I'm gonna come here, add it and delete. So now you can see we have a clean chart, but still I want to start Ableton from scratch so that those of you that are new to IQ option can actually understand how to do this. Okay, so when you open your chart on IQ option, this is exactly what you're gonna see. This is exactly your homepage or how your chart is gonna look like. This is called a trend line. And so now what we're gonna do is we're gonna change from this trend line to candlestick so that we can be able to understand what is actually going on and what the price is actually doing. So you should come here to chart type, click here, and then here you can see candles. Click candlestick and choose candlestick. Okay, so you can then, after choosing the candlestick, you should then come right here to candle time period, click it. You can see that now the chart the candlestick open after every 5 seconds, so we're going to change it to 1 minute so that we can have a clear and clean chart. So here's a 1 minute candlestick. What happens here is that and what 1 minute candlestick means is that after every minute we will have a new candle. So every candle you will see here opens and closes in 1 minute. So that is what the period means. As you can see now, we have a new candle, and what happened here is okay, so this is a very good moment for us. We're gonna wait here and see what is actually going to happen so that we can have one of our examples. Let's come to the bullish candles right here. Okay, so I want you guys to look at the morning star again, and then we will come back to the chart in a second. Look at the morning star clearly and look at it again. Now let's get back to the chart. Now, as you can see, we are about to have a morning star around here. Okay, but we're gonna zoom out and see. Yeah, so guys, you can see what happened here. Here's what happened. We have a large red candle, and then we have the neutral candle around here, and now we have a green hammer. So after that, we are now having a large green bullish candle, and this is actually showing us what is happening, except the problem here is that it is happening around a resistance level. Okay, this is actually the support level. I think this is good because if you look at the line around here, this is actually a support level. We have a breakout around here. So I'm gonna open this. So we're gonna try and open a trade around this section just so that we can see what will happen. So we have now opened a 1 minute position just to see, to test what will happen here. Awesome job. I hope you guys are with me. We have just opened a buying position or a long position or a buy order, trying to test a morning star. So we have just opened this for 1 minute, and hopefully we're gonna win this trade. Yeah, so we have actually won the trade. Congratulations to us. We have just made $85. That's great. Okay, so this is just to give you an example of this is a real life example of what we are actually talking about right now. We have seen a morning star happen around here, this section, and then we wait because Not just that, but it happened around a support level. As you can see, if we zoom out from the market structure, if you look at the market structure, we zoom out, you can see this is the support level. Okay, it is around here, here, and here. And so the morning star actually happened around a support level. Not just that, but we have a hammer, and also we have a large green candle, which tell us that the market is actually in a bullish momentum and that the buyers are actually in control of the market. And so that's what happened. And we have opened a 1 minute trade around here, and we actually won the trade, which is great. So let's get back into I think we can look at another examples, but I think we can now go back to actually finish because we are now running out of our time. And so let's quickly wrap up and finish what we are doing. So let's get back to the neutral candles. Let's remove the bullish candles. So this is what happened. We have now tested a morning star live, and we won the trade. And now we will continue with the neutral trade, starting with the doji. So just like you can see in your screen, this is actually a doji candle. We have talked about this doji candle in the last webinar. So if you have joined the last webinar, you actually knew what we're talking about here. And if you haven't joined, that's okay. The doji, it is a candle that open and close, and it is at almost the same, or exactly at the same price. So the open and the close are almost exactly at the same price. There's barely anybody at all. And what happened is that the buyers and the sellers have fought the whole candle and basically are tired. All of them are tired, and the fight or the war had ended up in a stalemate. So that is when you have a doji. It means that both sides are actually exhausted and they have all backed down. So nothing is actually, no one knew what's going to happen. Okay, don't assume that this means a reversal is actually going to happen, and don't assume that the market is going to go up or the market is going to go down. Just wait and see what the next candle does, because that's what actually tells you who wins. So god damn it, what the hell is going on around here? Well, I hope you guys are still with me. What the hell is going on? Well, I think we are having some okay, so guys, I hope you're all with me. um so that is actually a doji. When you say a doji, it is actually, what it's actually telling you is that the buyers and sellers have actually fought each other, and they are all tired. The war or the fight had ended up in a stalemate, and every side has already backed down because they are both tired. And so until the next candle, you don't know what is actually going to happen. You don't know if the market is going to go up or if the market is going to go down until the next round of that fight. And that is when it will decide who the winner is, either the buyers or the sellers. So that is what doji really means. And so then the next candle is the long ledge doji. It is the same idea as doji, but with a much longer wicks on both sides. And what that means is that price has swung hard in both directions during the candle before ending up back near where it actually started. Okay, so it is the same idea and the same story. It is even louder version of indecision, and it is often shows up right before a big move or in either direction. That's what happened. Okay, sometimes when you saw a long ledge doji, it actually shows before a very big bullish or bearish move happen, and that's why it is a much more, it has a much more longer wicks than the doji actually has. So that is the long ledge doji. Then the next in line is the spinning top. A spinning top is a small body with wicks on both sides, on top and beneath it. And those two wicks are roughly similar in length. You can measure them and they are roughly similar in their length, just like a doji, but it has a small real body instead of almost none or almost nothing. And what happens is that it tells you the battle between the buyers and sellers was close and there's no clear winner. Again, you have to be patient because patience is the right move here. Okay, so that is the spinning top. And then the last in line is the high wave. A high wave is similar to a spinning top or a spinning top, but with much more longer wicks on both sides, just like the long ledge doji and the doji. It is showing wild and aggressive swings in both directions within a single candle. And this usually or this actually signals real uncertainty in the market. And it often shows up during moments of big news or high volatility in the market. So that is high wave for you. Okay. And so all these first four chart patterns are actually um, neutral patterns. They are not telling anything and they are not actually telling you anything at all. So yeah. So now let's zoom back out into the bigger picture and two chart patterns that actually help you answer the questions everyone is been asking themselves. Where do I actually enter? Now we come to the end of the live stream or the end of the webinar. So we have just two things to cover in 2 minutes, and then we will wrap up and close the live stream. And so guys, if you have any questions, you can ask in the comment section because we just come to the end of the live stream. So we have less than 3 minutes to cover or to actually finish. So here's a double top. Let me move the QR, the promo code up here so that we can see the double top clearly. Okay, guys. So this is the double top. A double top forms when price rallies up to a level, pulls back, rallies again to roughly that same level, and then fails to break through a second time. It looks like two mountains or the letter M. So sometimes it looks like the letter M, and sometimes it looks like two mountains. And those two mountains, for example, are peaks or they are peaks sitting side by side at almost the same site or the same height or the same level. And so that is double top. And why does this happen? So to answer the question, the first peak shows that buyers are pushing as far as they can. They are pushing the price as far as possible or as far as they possibly can. And then the pullback shows some selling, some sellers stepping in and trying to push the price down. And then buyers comes in again and trying to push the price up again. But this time at the exact same level, at that same level, they fell once more. And so just like they fell the first time, now they fell again, but at almost exact level, which tell you that buyers have run out of strength or they run out of gas, whatever, at that exact price, and that sellers are now firmly defending that position, which means that the sellers are now in control or the sellers have more power at this point. The line connecting the low point between those two peaks is actually called the neckline. You can see it in your screen. When price breaks down through that neckline and closes below it, that is your confirmation that this is a double top. and this is a potential, or it means that now there's a potential selling opportunity that the market is going to go down, and that you should sell at that point, because there's a higher chance that the market is now going to go in a downward direction. As I said, just like every single pattern tonight we talk about, you have to wait for that neckline break to actually close before acting. Don't jump in on the first peak, and don't jump in on the second peak, or just because you see or you saw that those two peaks forming. You have to wait for the neckline to genuinely break before you enter a selling or a short position, or before you enter a sell order. And so now let's flip this pattern upside down for when the market is trying to find a bottom instead of a top, which is why we call them double top and double bottom. So let me show that in your screen. So here's the double bottom, and it is just the mirror of the double top. It is simply it actually tells you when price, or it actually forms, as I just said, it is just the simple it is simply the mirror of the, or the mirror image of what we just learned on the double top. So when price falls to a level, bounces and falls again to roughly that same level, just like the bottom but just like we just talked about previously now on the double top. So when the price bounces and then falls again to roughly that same level, and it holds a second time instead of breaking through it, it looks like two valleys sitting side by side at almost the same depth, or it looks like the letter W. So just like the double top looked like the letter M, the double bottom looks exactly, or looks similar to the letter W. So again, there's a neckline here as well, and this time it is the line connecting the high point between those two those, those, those two truths. When price break up through that neckline and closes above it, that is your confirmation of a potential buying opportunity or a long trade. But you have to wait for that to close above the neckline, just like before. You have to wait before you act. You have to wait for the neckline, for the price to close above that neckline. And also, exactly, you have to have the discipline and the patience to wait. So you have to be patient. You don't have to rush entries just to open a position, or just to actually be in the market. Okay, so now we have covered everything from the basic structure to the market, all the way through the 14 the candlestick patterns, and two of the most reliable chart patterns out there, which is the double top and the double bottom. And so if you bring all this together now in a simple checklist, which I'm trying to do right now, even though we have less than 2 minutes or less than 1 minute to to actually close. But here's the entire session compressed into one repeatable process. So I have this slide. Let me show it in the screen before we leave. Yeah. So here's the entire session compressed into one repeatable process. And I want every one of you to either screenshot this or to take note of this. First, you can check the trend. Are we making higher highs and higher lows, or are we making lower highs and lower lows? Second, you then find the level. Is price at the support level or at the resistance level? Is the price at the floor or the ceiling? Is price at the support or the resistance zone? That's actually been respected before, right? And then the third one is we have to wait for the candlestick for confirmation, which is you can take the candlestick out of those candlestick patterns we just talked about, and so you need your confirmation, which is the third confirmation. Is there any candlestick patterns forming right at that level? Either it is a morning star or evening star on a support level or a resistance level. And then fourth, we have to check for a pattern, a chart pattern. Is there a double top or a double bottom, which is actually adding an extra weight to the setup? And only after all those things have formed that you can actually have an entry. And also, it is very important for you to have a risk management uh, just before you start trading, so that you can protect your capital. You know that I always talk about having a risk management so that you can protect your capital and you can protect your account, and you can also protect yourself from blowing up your account. So uh, this is what we are actually talking about, right? So let's just say in just one sentence. Oh, just forget about that, because we are now out of time, and we have actually uh, closed it. Sometimes you just have to look at the trend, support, resistance, candlestick confirmation, and then look up for a chart pattern before you enter. But also you can you have seen what happened, and I gave you a real world example of how you can use these things. So we have the example, we have everything, and now we run out of time, so we're gonna close right here. We have covered absolutely everything we have to today, and I'm gonna get back to the chat before closing so that we can close looking at our chart. So all right, guys. Well, we have some two questions here. And what if the red hammer is inverted? What do you have? If it is a green inverted hammer, it still means that there's this guy Okafo Miracle 72. So I'm responding to your question quickly before we close because we actually run out of time. And let me even open the bullish candles for you so that you can understand much more clearly of what I'm actually talking about. Uh, Windows, yeah. Okay, so as you are asking about where is this guy? What if the green hammer is actually inverted? So you can see there is an inverted hammer. You can see it in the screen. Maybe you are not available at the time, or now that you can see it. So this is an inverted hammer. And when you saw an inverted hammer, it actually means that there's a possibility that the market is actually gonna go up, or the market is gonna continue in a bullish trend or in a bullish direction. But this is very important. It doesn't guarantee that the market is actually going up. It is a much more weaker signal than the hammer. The hammer is much more stronger signal than the inverted hammer. But at the same time, an inverted hammer is still telling you the market is going up, but you have to take note, it is weak. It is not as strong as the hammer itself. So that is your answer. And then what if the hammer is red? So at the same time, let me open the bearish candles for you. You can see there is a hanging man. Okay, so the same thing as the inverted hammer, it is also the same thing. It's just the mirror of the inverted hammer, and here is just the mirror of the shooting star. The same signal, the same story, but what it means is that this one is much more weaker than the shooting star, and it is much more weaker than the hammer itself. So they are telling you the same thing, except they are not as strong of a signal as their previous predecessors, if you would. So that is your answer. Or that is the answer to your question. Okafu miracle, and then the last guy we have this one asking, as a beginner, what is your advice? And so my advice is to be very patient. You have to learn these things and then implement them. Don't use your real account. Don't trade on your real account. Okay, trade on a demo account. Everything you learn tonight, you can then apply them on the market, but don't trade with your real money. You have to first trade on a demo account, try all these chart patterns, and that's exactly why I gave you this roadmap. That's why I gave you this roadmap. So you guys should take screenshot of the roadmap or come back to this live stream after we finish so that you can see this clearly. The roadmap tells you what to do. Okay. So as a beginner, you have to test everything you learn tonight. Try everything on a demo account, not on a real account. And after you finish, when you have the confidence that now you understand everything and now you are winning trades on a demo account, until then you can try and test your skills on a real account. So that's my advice for you. And also you have to study a risk management. Maybe in our next webinar we're going to talk more on the risk management and all of that, but today we have covered the chart patterns and everything you need to know about price action and the entire chart chart thing, whatever. So that is everything for tonight, and from why we drop the indicators through, but we will talk about all these things in another webinar. But what I want you to know is that it doesn't mean indicators are bad. So if you are with us from this from the last webinar to this webinar, you have know right now, or by now you have understand why we drop the indicators through structure, and instead replace them or use structures, labels, breakout, and the candlestick patterns, bullish and bearish, and all the candlestick patterns, double tops and double bottoms, just like we just covered them a few minutes ago. And finally, we have a simple checklist. Every one of you guys have a simple checklist which you can use on every trade from here on, so that it can help you to make a or to find an entry and to make a better trading decision. So whatever, even if it helps a little bit, that is great. So please follow the official IQ Option channels. You have to follow this account, this IQ Option YouTube channel, subscribe and click the bell icon so that you will not miss any educational content and live stream that we're going to be hosting. Our next webinar will be next week, and so I will see you guys. So don't miss the next session, don't miss the next webinar. And genuinely, thank you all. I thank you very much. Thank you so much for spending this hour with me. And I really appreciate every one of you guys. And I hope you genuinely learn this valuable information. And I hope they're going to help you in your trading journey. And I will see you in the next session. Thank you guys, and see you next. Thanks everyone for joining us. See you.